The stock market has been on absolute fire in 2024 with the S&P 500 already up nearly 14%, and my portfolio has really been reaping the benefits. My dividend growth portfolio currently pays me $484 on average every single month, but I've also been seeing some massive gains from the positions in my portfolio. For example, we can see I'm up nearly 200% on my broad composition, JP Morgan nearly 98%, Caterpillar 91.5%, with many other positions up over 50%. Despite this market run up, I still believe there are opportunities to buy quality dividend paying companies at good valuations. I love dividend investing, but more specifically, I love dividend growth investing. Dividend growth stocks are companies that increase the amount they pay out in dividends every single year. And the end result of this is a massive snowball effect, allowing your portfolio to turn into a passive income machine. So in this video, we're going to be looking at 10 dividend growth stocks that I believe could be good additions to your portfolio in the second half of 2024. Now, nobody knows how the market will perform over the next 6 months, but I do believe that each of these companies mentioned today could be good options to add to your dividend portfolio long term. I currently own 7 of the companies on the list and actually have the other 3 on my watch list right now, but I believe all 10 of these companies could potentially help me achieve my long-term goal of one day living off dividend income. To analyze these stocks, we'll be using my automated spreadsheets from tickerdata.com, which you can go to at the link in the description. Now let's dive in. Stock number 1 on our list is one that is down pretty big in 2024, and that is Starbucks, stock ticker SBUX. And you can see all this data is going to automatically load in, again, thanks to the ticker data add-on. But here's what's impressive about this stock. If we come over here, we can see over the past 5 years, they've increased their total dividend payouts over 68%. That's a pretty big increase in their dividend payments. Now, if we jump over to Seeking Alpha, we can see in the past year, down 27.34%, and we can see there was a huge sell-off in late April. Now, why is this? Well, this actually came after an earnings report, and if we take a quick glance at this earnings report, there's a couple of different things that we can note. If we look at Q2 North American segment results, we can see they had a 3% change in comparable store sales, and change in transactions was down 7% as well, but ticket prices were up by about 4%. Now, one of the things we can also see is their operating margin was down. It was sitting at 18% in Q2, but compared to last year during this time, it was 19.1%. And if we look at international segment results, it doesn't get much better. If we come down here, change in comparable store sales down 6%, change in transactions down 3%, and change in ticket prices down 3%. And there's a major decline in margins. We can see operating margin was 13.3% when last year it was sitting at 17%. So this earnings report led to a huge sell-off in the stock. Now, what's interesting about this is if we jump over to our profitability spreadsheet, come up here, plug in SBUX, and you can see this data will automatically load in. Now, if we come over here and look at revenue versus cost of revenue, we can see pretty much every single year over the past decade, with the exception of 2020, revenue has been increasing for this company, and gross profit ratios have been relatively steady, again, with the exception of 2020. The 10-year average gross profit ratio was sitting at about 28.5, and in 2023, it was sitting at 27.37%. Now, if we look at this company from a dividend investor standpoint, come up here, plug in SBUX. We can see the dividend history for Starbucks actually looks very good. Now, the starting dividend yield right now is pretty decent, sitting at about 3.05%. And if we look at their dividend history, this is what's beautiful about dividend growth companies. If we look in 2013, they're paying out 45 cents per share, but in 2023, they paid out $2.16, and this year they're paying out $2.28. So over the past 10 years, they have a 10-year dividend CAGR of 15.28% and a 5-year of 8.88%. So a great history of increasing those dividend payments, and we can see their free cash flow payout ratio is 66.17%. Keep in mind, dividends are paid out of free cash flow. So a company needs to be generating much more free cash flow than they're paying out in dividends in order to sustain dividend growth. And we can see in 2023, free cash flow was sitting at about $3.6 billion, and dividends paid out was sitting at about $2.4 billion. So historically speaking, this has been a great dividend payer. They're struggling quite a bit this year, but what's interesting is if we look at the valuation from a simple price to earnings standpoint, price to earnings non-GAAP for Starbucks sitting at 20.95 when their historical 5-year average is sitting at 29.78. So compared to how they've historically traded, they do appear to be undervalued. The company definitely has some problems to face moving forward, but this could be a good opportunity to consider adding shares. Our next stock on the list pays out very big dividend payments, and that is none other than stock ticker MO, Altria Group, and we can see this company is trading at $49.42, and the starting dividend yield is sitting close to 8%, and over the past 5 years, they've increased their dividends by a total amount of about 33%. So that's a great combination of massive dividend payments along with dividend growth over the past 5 years. And if you look at them over the past year, they've done pretty good, up 8.38%, and year to date, up 22.51%. Now, if we jump over to the stock screener for this company, come up here and plug in MO and hit enter. And we can see all this data will automatically load in. Now, what's really interesting about Altria is they have a surprisingly high level of return on invested capital. For example, we can see in 2023, return on invested capital was 39.27%. Now, what does ROIC tell us? Well, it tells us exactly how profitable are the projects that the company is investing into. And typically we want to look for an ROIC of above 10%. So when you see high levels of return on invested capital, that's a sign of a quality company. And a lot of times those companies have pretty heavy pricing power. If we jump over to the profitability sheet, plug in MO. One of the things you'll notice is yes, revenue growth is not too fast. It's pretty slow actually over the past decade, only about 1.5% 10-year revenue CAGR, but we can see their 10-year net income CAGR is actually at about 6%. So how is this so much higher than revenue? Well, we can see the gross profit ratio again has steadily been increasing over the past decade. Again, a sign they have pricing power. That 10-year average gross profit ratio at 62.7, while in 2023 it was close to 70%. Now, if we look at this company from a dividend perspective, again, the big dividend payments are why so many people love Altria. Look at that, nearly 8%. And we can see along with this, they have a rich history of increasing dividends. And in fact, this company is a dividend king, increasing dividend payments for over 50 consecutive years. And over the past 10 years, they have a dividend CAGR of around 7%. Now, here's a huge concern for most people, and that's the payout ratios. Many people are concerned Altria cannot continue to sustain these big dividend payments, but here's what you have to understand. In a recent open letter from the CFO of Altria, he pointed out something very important that a lot of people don't seem to understand. He stated that since 2010, our objective has been a dividend payout ratio target of approximately 80%. And then he went on to state that he's establishing a new progressive dividend goal that targets mid-single digits dividend growth annually. So this gives us really important insights into the goals with the dividend payments for this company. We have to keep in mind, their target payout ratio is sitting around 80%. So the high payout ratio is not on accident. Management has analyzed the company and has decided that the best way to reward their shareholders is currently in the form of dividends. There's 5 different ways a company can use free cash flow. They can reinvest back into the business, buy back shares, pay out dividends, pay down debt, or attempt mergers and acquisitions, and the main focus for Altria is paying out dividends. And what we can see is they've actually maintained a free cash flow payout ratio of close to around 80% for the past few years, exactly what management is targeting. So if we look at the free cash flow versus dividends paid out, we can see since 2018, free cash flow has easily been covering those dividend payments in line with management's goals. Now, the third company we're going to look at is one that is very, very different than Altria Group, the company we just looked at, and that is Visa, stock ticker V. We can see the company has a very low starting dividend yield. It's only sitting at 0.82%. But look at how much they've increased their dividend payouts over the past 5 years. Over 100%. So they've more than doubled their dividend payments during this time period. Now, the past year, they're up about 5.58%. But actually, if we look at them just year to date, they're down about 2.37%, while the market has been on a tear. They're currently trading at $254.17. Now, Visa is one of the larger positions in my personal portfolio. And if we jump over to the stock screener, let's come up here and plug in V. This data will load in and you can immediately see there are some big signs that this is a very high quality company. First off, look at revenue per share. This is the top line of the company. All the money they bring in, this is revenue. Revenue per share in 2013 was $4.51, and in 2023, it got all the way up to nearly $16 per share. So top lines are growing at a high rate, but we can also see the earnings per share of the company is following, and so is free cash flow per share, going from 98 cents per share in 2013 all the way up to $9.62. We can also see return on invested capital very high, sitting at 29% in 2023. They've also bought back a ton of shares during this time period, going from around 2.6 billion to in 2023 around 2 billion. This is a good sign. And if we jump over to the profitability spreadsheet, again, plug in V. Something else very impressive about this company is they have extremely high profit ratios. Look at the 10-year average gross profit ratio, sitting at about 80.7%, and it's stayed very consistent over the entire decade. This is another sign that it's a high-quality company. Now, if we look at them from a dividend perspective, the charts we'll see here are absolutely beautiful. Look at the dividend growth over the past decade. They have a 10-year dividend CAGR of 17.35%. That is rapid dividend growth. And what's even more impressive is for the entire duration of the past decade, they've had a very low payout ratio and free cash flow payout ratio. Look at this. free cash flow payout ratio in 2023 was just 19%. So we can see they are generating way more free cash flow than the dividends they're paying out. Free cash flow in 2023 was sitting at over $19 billion, while dividends paid out was only around $3.7 billion. And to show just how much cash they actually have, if we jump over to the balance sheet breakdown, plug in V, we can see the company has a current ratio of 1.45. Now, what does this tell us? Well, the current ratio is simply the total current assets divided by total current liabilities. So it helps us understand how easily a company can meet those short-term obligations. So we want to look for a current ratio of over 1, and Visa easily meets that standard, sitting at 1.45. So this is actually one of the highest quality stocks in my personal portfolio, in my opinion, and I'm very excited to hold it long term. For our fourth stock, we're actually going to go back and look at a higher yielding position, and that is ADC. That stands for Agree Realty Corporation, and this company is a real estate investment trust that pays out dividends on a monthly basis. We can see the starting dividend yield sitting at about 4.42%, and over the past 5 years, total, they've increased their dividends by about 42%. So again, a good combination of starting yield and dividend growth. If we jump over to Seeking Alpha, we can see over the past year, they're pretty flat, down by about 0.53%. But year to date, we can see they're up around 7.78%, and they've actually jumped up quite a bit just in the past few weeks alone. Now, it's been said before that REIT is only as good as the tenants in its portfolio. And if we look at the tenants in Agree Realty's portfolio, we can see pretty popular names that we're familiar with, and they're considered pretty quality business. We have companies like Walmart, Tractor Supply Co., Dollar General, Best Buy, CVS, keep coming down. We can see Dollar Tree, Kroger, even companies like Lowe's are in their portfolio. These are companies that I don't expect to go away anytime soon. And in fact, if we scroll down, we can see 69% of their portfolio is considered investment grade. And for some perspective, that's actually higher than Realty Income, another very popular monthly dividend stock. If we look at our dividend breakdown sheet and plug in ADC, again, we can see solid starting yield at about 4.42%, good history of dividend increases with a 10-year dividend CAGR of about 5.6% in the 5 years, sitting at 5.64%. But look at the payout ratio, 167.75%. At first glance, that seems like a pretty bad sign, but we have to keep in mind, this is a real estate investment trust, and REITs are required by law to pay out 90% of their earnings in the form of dividend payments. So we actually can't look at the payout ratio. This doesn't give us an accurate representation of how safe those dividend payments are. Instead, let's jump over to Seeking Alpha, click on dividends, and click on dividend safety. And if we scroll down, we can see something called the AFFO payout ratio. That stands for adjusted funds from operation. This is the actual metric we should be looking at to see if those dividend payments are safe. And we can see this is sitting at 72.76%, meaning that the dividend payments from this real estate investment trust are currently safe. So history of increasing dividends, nice starting dividend yield, the dividend is safe, and they pay out dividends on a monthly basis. Seems like a pretty good deal. The fifth company we're going to look at is actually one that I added to my personal portfolio earlier this year for the very first time, and that is UNH, and that is United Health Group Incorporated. The starting yield is a little bit on the lower end, but again, they have rapidly increased their dividend payouts over the past 5 years. They've more than doubled it at 111%. And again, if we look at my do-it-yourself investor toolkit and blow up my growth chart, I've actually already seen decent gains from this new position in my portfolio. I'm up a little over 23%. Now, the investment thesis is actually pretty simple behind this stock. Healthcare is a rapidly expanding industry. In 2022, healthcare costs skyrocketed to $4.4 trillion, and the Center for Medicare and Medicaid Services is projecting that by 2030, healthcare expenditures could reach $6.8 trillion. If we jump over to our stock screener, come up here, plug in UNH, and we can see the charts that load in are really some of the most beautiful that you'll see out of any company you'll analyze. Revenue per share consistently growing, free cash flow per share consistently growing, earnings per share consistently growing, shares outstanding declining, which is a good sign. The debt to assets ratio appears to be in a very healthy range, and very consistent returns on invested capital of around 15% over the past few years, and in 2023 it was around 17%. If we jump over to the dividend breakdown sheet, we'll come up here, plug in UNH, and you'll quickly see everything looks really, really good. Yes, starting dividend yield, but the dividend growth is massive. 10-year dividend CAGR of 19.58%. Look how much that dividend has grown over the past decade, going from $1.05 all the way up to $7.29, and they've maintained a very low free cash flow payout ratio during this time. The free cash flow payout ratio has remained below 30%. Keep in mind, like I mentioned earlier, if a company isn't having to use much of its free cash flow to pay out dividends, that gives them the option to reinvest back into the business, allowing them to grow free cash flow more, which will then allow more share price appreciation. And in fact, if we look at UNH over the past decade, we can see that's exactly what's happened. They're up over 581%. Extremely impressive share price appreciation, dividend growth, and it's because they've been backed by free cash flow growth. Our sixth company is another real estate investment trust, and it's actually one of my favorite REITs out there. That is none other than VICI, Vici Properties. They have a big starting dividend yield, sitting at about 5.5%. And if we look at this company, we can see over the past year, like most REITs, they've struggled a little bit. They're down by about 8.12% due to the high interest rate environment. But if you look at them in just the past month alone, they're actually up around 6.67%. Now, if you're not familiar with Vici, this is a company that owns real estate in Las Vegas. And there's a few things about this REIT that make me really like them. First off, we can see 100% of their tenants operate with a triple net lease agreement. Now, what does this mean? Well, it essentially means that the tenants are responsible for paying the rent, paying the taxes on the property, paying the insurance, and also paying the maintenance. This makes the cash flow that Vici receives very, very predictable. They don't have to worry about all those other things. If we keep scrolling down in this investor's presentation, something else we can see is 2020. We already know this was a really difficult year for REITs. But if you look at Vici in 2020, they were still able to collect 100% of their rent. And then perhaps one of my favorite things about Vici Properties, we can see 50% of Vici's rent roll has CPI-linked escalation. So basically that means right now 50% of their portfolio, of their tenants, is safe from inflation. But we can see by 2035, that is projected to be 96%. So even if inflation got really high like it has been over the past couple of years, Vici will be protected from this. Their rent will automatically increase based off inflation. This is a huge plus for Vici. And then finally, if we jump over to the dividend breakdown for this company, again, we can see the starting dividend yield sitting at about 5.5%, solid dividend growth over the past 5 years. And remember, this is a real estate investment trust, so we need to look at the AFFO payout ratio. So if we go over to Seeking Alpha, scroll down, we can see right here, AFFO payout ratio sitting at 75.8%, so it looks like those dividend payments are safe. Our seventh stock is one that I see very rarely talked about in the dividend investing community, and that is stock ticker LVMHF, and that stands for Louis Vuitton. This is a company that has a starting dividend yield of around 2% and has rapidly increased their dividend payments over 131% total over the past 5 years. If we look at them over the past year, they're down quite a bit, down a little over 25%. Now, if you're not familiar with Louis Vuitton, they sell luxury goods, and this is something I was actually talking about on Twitter the other day. I was breaking down their revenue sources. You can see we have selective retailing, wine and spirit, fashion and leather goods, perfume and cosmetics, and then watches and jewelries. And you can see over the past 15 or so years, they've actually made quite a few acquisitions as well. Now, here's what's really interesting about this company being down over 25% over the past year. If we look at the insider purchases for this company during that same time period, we can see insiders at this company have been buying this company hand over fist. There have been tons of insider purchases over the past year and only one insider sell. So the insiders in this company do appear to have quite a bit of confidence in this company. If we jump over to our stock screener, we'll come up here, plug in LVMHF. And again, we see some signs that this is a pretty high quality company. First off, pretty good top line growth. Revenue per share has gone from around $58 per share all the way up to in 2023, $172 per share. Earnings has followed, free cash flow has followed. So that means all the money they're bringing in on their top lines has found its way to the bottom line as well. We can see debt to assets ratio appears to be in a pretty healthy range, and return on invested capital last year sitting close to 20%. That's a range that I really like. If we jump over and look at the dividend metrics for this company, LVMHF, like I mentioned earlier, starting dividend yield is sitting at about 2%, and the 10-year dividend CAGR really nice, close to 14%, and the 5-year sitting at about 15.12%. Now, from a dividend perspective, there's a couple of things we have to understand about this company. First off, if we jump over to Seeking Alpha and actually look at these dividend payments, not on a yearly basis, what you'll see is they actually pay out dividends on a semi-annual basis. So they pay out dividends twice a year, and the amount they pay out varies. So for example, we can see in 2022, in April, they paid out a pretty big dividend, but then later that year, the dividend was quite a bit smaller. So typically they have a large dividend payment earlier in the year, followed by a smaller dividend payment. And speaking of the dividend history, you have to understand, Louis Vuitton is a company based out of France. So it's important to understand, depending on where you are, you may have different tax implications when it comes to this stock, and you might not even be able to buy it with your brokerage, but I do have a link to Interactive Brokers down in the description. This is one of the places I've started buying and selling stocks, and they will allow you to buy international stocks like Louis Vuitton, so check them out if you're interested. Now, like all high quality stocks, the reason they've been able to grow dividends at such a high rate is because free cash flow has been growing at such a high rate as well. We can see 10-year free cash flow CAGR at 13.5, and the 5-year sitting at 12.43%. So the reason we can see dividends growing is because free cash flow is growing. The 8th stock on our list, again, another real estate investment trust, and this is a popular one, and that is stock ticker O, and that is Realty Income Corporation. This company is trading at $57.26 per share, has a high starting dividend yield sitting at about 5.52%, and over the past 5 years have increased their dividends total by about 16%. Now, Realty Income is actually stock I wrote a pretty in-depth article on Seeking Alpha not too long ago, but here's what a lot of people need to understand about this company. REITs have really been held down over the past year by the high interest rate environment, but we can see Realty Income stock price has dropped significantly in the past 5 years, but its AFFO per share during this time has grown 28.5%. So the company's bringing in more money, but the stock price went down. To me, that signals they're trading at a pretty good valuation. We jump over to Seeking Alpha, we can see over the past year, they're up by about 9.64%. And if we look at them year to date, they've traded pretty flat, down by about 0.28%. Now, this company prides itself in one main thing. They're known as the monthly dividend company. They have it plastered on their website. And if we jump back over to Seeking Alpha and look at the dividend history for this company, we can see what those monthly dividend payments look like over the past decade. Very predictable and very stable. We haven't seen any dividend cuts, and in fact, this company is actually a dividend aristocrat. They've been increasing dividend payments for 25 consecutive years. So that's a really good track record, especially for a real estate investment trust. And in fact, if we look at the dividend safety, we can see I don't think that'll be changing anytime soon. If we look at the AFFO payout ratio, it's sitting at about 74.74%. So if you're someone who likes big dividend payments, sustainable dividend payments, and on a monthly basis, this could be a pretty good option to look at. Our 9th company is not one of my portfolio, and I haven't talked about it a whole lot on the channel before, but it is a popular company, and that is MCD. That is McDonald's. This company is pretty close to their 52-week low right now, and we can see currently trading at about $253 a share with a starting dividend yield of about 2.64%, and their total 5-year dividend growth is sitting close to 49%. If we jump over to Seeking Alpha, over the past year, they're down by about 14.2%, and we can see 52-week low for this company is about $243, so they are pretty close to that range. Now, a lot of people think they're familiar with McDonald's. They know they sell hamburgers, chicken nuggets, and occasionally ice cream when the machine's not broken. But this is actually not exactly how they make most of their money, and this is, again, something I was talking about on Twitter the other day. If we look at McDonald's business model, we can see there's actually 3 different ways that McDonald's makes money. They make money from rent, royalties, and initial fees and profits from directly operating restaurants. But the majority of this is going to come from rent and royalties. For example, 55% of McDonald's restaurants have conventional licenses. What this means is McDonald's provides the building and the real estate, while the partner provides the equipment. And in exchange for this, McDonald's receives rent and royalties. And then we can see 20% of McDonald's restaurants have developmental licenses. This is where McDonald's pretty much doesn't have to do any upfront investment. They basically just let the franchise run the restaurant, and in exchange, they receive royalties. And then we have 20% of restaurants being foreign affiliated. It's pretty similar. And then only 5% of restaurants are completely owned by McDonald's, where they provide the equipment, the building, and the real estate, and they receive all operating profits. So it's a pretty interesting business model. If we jump over to our stock screener and plug in MCD, if we jump over to the dividend breakdown sheet, we'll come up here, plug in MCD, and we can see again the starting dividend yield sitting at about 2.64% with pretty solid dividend growth over the past 10 and 5 years, both of them being at around 7%. So again, we can see a pretty good history of dividend growth during this time period, and that dividend growth has been backed by free cash flow growth as well. Now, the free cash flow payout ratio is honestly a little bit higher than I typically like to see it, sitting at about 62.48, and we can see the year before that, it was actually sitting at about 75 to 76%. So long term, I'd like to see them get this free cash flow payout ratio a little bit lower. And then finally, our 10th company is MSCI, and this company has had a pretty rough year so far, but over the past month, they've actually seen a jump up due to the recent earnings report. Now, the starting dividend yield is low. It's sitting at about 1.2%. But look at this 5-year dividend growth. It's the highest out of all the companies we've looked at today. Nearly 200%. They basically tripled their dividend payment over the past 5 years. If we jump over to Seeking Alpha, we can see over the past year, they're up around 6.26%. And if we look at them year to date, they're down by about 5.56%. Now, if we jump over to our stock screener, let's come up here, plug in MSCI, and hit enter. And immediately we can see a lot of signs of a high quality company. These charts look beautiful. The revenue per share has grown tremendously over the past decade, going from about $8.62 per share all the way up to $31.83. And look at the free cash flow per share growth, the earnings per share growth. The company is growing their earnings at a very high rate, and the growth has been very predictable and very stable. Those are two things that investors absolutely love to see. Now, they've also bought back a tremendous amount of shares outstanding during this time, going from around 120 million now all the way down to around 79 million. And you have to understand, when a company is buying back shares, this means it's going to boost all other per share metrics. So this helps increase earnings per share, revenue per share, and free cash flow per share. So buying back shares can be a great way to reward shareholders. And then we can see debt to assets appears to be in an okay range, and return on invested capital, especially last year, very high, sitting close to 30%. If we look at the profitability for this company, MSCI, we can immediately see another sign of a high quality company. Look at the 10-year average gross profit ratio, sitting at 78.15%. And as of 2023, it was actually as high as 82.34%. So rapidly growing free cash flows, revenue per share, high levels of return on invested capital, and very high gross profit ratios, all signs of a high quality company. And if we jump over to the dividend breakdown sheet, we'll come up here, plug in MSCI. Again, we can see the starting dividend yield. Yes, it is low, sitting at about 1.2%. But look at the 10-year dividend CAGR. It's basically 43%. Now, to be fair, the company basically started paying out dividends in 2014, so they were starting pretty much at zero, but still, that's pretty tremendous dividend growth during that time period, and in the past 5 years alone, sitting at about 20.49%. And the payout ratios have remained in a healthy range as well, with it currently sitting at about 38.51%. And free cash flow, again, this is growing at a rate of over 15%. So remember, as long as the free cash flow is quite a bit higher than the dividends paid out, like we can see here, the company can continue to grow at a very high rate and also grow their dividends at a very high rate. So there you go, those are some of the top dividend stocks for the second half of 2024. Again, nobody knows how any of these stocks will perform over the next 5 or 6 months, but these are stocks that I believe could be a good addition to your portfolio if you're a long-term dividend investor. We have stocks on this list with massive dividend yields, and some with lower dividend yields but massive dividend growth, and then we have some that are a pretty good combination of both of those things. Now, like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. If you want to learn even more about dividend stocks and dividend investing opportunities, be sure to subscribe to the channel, but also consider signing up for my free weekly newsletter at the link in the description. So with all that being said, go ahead and let me know what you think in the comments down below, and please don't forget to like and subscribe to the channel.